Good morning, everybody. Again, from the morning reading, the small cap Russell 2000 index is almost closed at a new 52-week high, while the wildly benchmarked S&P 500 lags its own high. This is typically interpreted as bullish factor for stocks, but it has not consistently proven to be so. In fact, it has been more negative than positive. Yesterday, the concern that we took a look at was the increase in volatility via 1% days, and whether that meant that an uptrend was coming to an end. Well, as so often happens, there wasn't much to that ideal. Often it's just as beneficial to know what doesn't work as it is to know what does. Well, today we had the new high with the small cap Russell 2000 index. We're seeing kind of the opposite. Not one of concern, but of relief that small caps are leading us higher. When small caps lead the other major indices, then it's a sure sign that the broader market will also hit new highs, or so the theory goes. The data, in fact, shows that every time since 1979 that the small cap Russell 2000 closed at a 52-week high for the first time in at least 10 days, while the S&P 500 was at least 1% below its own 52-week high at the same time, the S&P performance going forward was mixed at best. Its returns tended to be below average, but not statistically significant except for 1 year later. These kinds of arguments assume that the good news for small caps to lead are persuasive and logical, but logic doesn't always rule in the auction markets, and this is just an example of that. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit. In this daily video, I provide my opinion of insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:27 a.m. Central Time, and I'm recording this in preparation for the market day of March the 18th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see what we've got going into FOMC day. That will be what will rule the day today. In fact, we'll likely have relatively narrow range action, especially after the first hour of trading today, as things go usually flatline into the FOMC, and then of course that'll be a binary event, much like an earnings report would be for a individual company. And our broad market indices overnight generally a little bit weak, down about 0.25%. Crude oil down big, again down 2.85%, over $1 on crude oil. So very, very difficult to find a bottom in that market as of yet. Euro up marginally. The bonds were up pretty nice, up about 22.30 seconds, and gold marginally up, as is kind of the case with euro. In terms of overseas markets, China up big, up over 2%. Hong Kong also up nicely, about 1%. Japan about 0.5%. Germany down about 0.8%, with the United Kingdom up about 0.5%. So for the most part, U.S. markets down and overseas markets generally up coming into the time that this was cut. Macroeconomic reports, of course, the headline is FOMC statement and Fed funds rate. You also, let's see if there was crude oil inventories. Indeed, on Wednesday, you have crude oil inventory. So that's your macroeconomic reports for today. Tomorrow, what you have to look for, you have Philly Fed manufacturing, the usual unemployment claims, natural gas as usual. So really, this Philly Fed manufacturing would be the addition to the usual Thursday routine. In terms of our current volatility, relatively low, obviously all in the lower half, with the Dow having the highest implied IV percentile. And really, there was no standard deviation moves yesterday, and today will also likely be small until we get to the FOMC report. Really, I don't see anything in terms of volatility to get particularly excited about, with the exception that short-term volatility has been elevated compared to intermediate term of late, and that probably has a lot to do, again, with that FOMC report. In terms of our daily report, no rollovers in futures markets this week. We're starting to get a little bit better conditions across our various metrics here. In fact, you'll see a lot less red today. We are still what we believe in phase 3, looking for higher highs and higher lows, though there's been an awful lot of range type activity in recent weeks. Investor posture, the IBD status is still with a cautionary uptrend under pressure, though the GMI index did elevate today to a 6 out of 6. So they're all go on that side. Active trader market posture is bullish, so that also has improved. Portfolio position sizing based on investor buy long side exposure up to 50%, so a cautionary metric there. From a volatility standpoint, it's all go 75 to 100%. So you still see this IBD status with this uptrend under pressure and the investor position sizing opinion a bit reduced, but other good signals coming through. Market timing today neutral to slightly, very slightly bullish. FOMC tends to be a bit bullish, but that will become a probability with the news, not in the early morning activity in general. 3-day outlook also neutral with 2 weeks slightly bullish. Market posture across the 4 indices. We are in our second day bullish stance for the SPX. The RUT was already bullish. So you have both of those have been bullish for more than a day, whereas the Dow and NASDAQ turned market posture bullish just yesterday. So we do have all 4 broad indices now with a positive or bullish market posture. And normally we would say that's, hey, that's first day all go to make new bullish short-term or intermediate-term trades. But obviously with the stance of today being FOMC day, we would suggest additional caution until that news release and that information has been digested by the markets and you have some clear indication as to where trend is going. So we're not lowering the hedge warning status as of yet. We still have threshold level 1 yellow, looking for a cleaner profile, and you see this from a volatility base. We still have some warnings. We have market and decline warning, a sharp increase warning. We still have a very high number of distribution days with S&P and the NASDAQ at 5. So in fact, if you also look at the intermediate term, the most recent swing is a lower low. So there's a number of factors here which still cause us to have this hedge level as a 1. You see in the intermarket risk aversion indicators, we've now got 3 of the indicators have gone risk off, and the other 2 probably could be best characterized as neutral. So again, more warning signs. Current opinions for option income strategies. VIX is inside the acceptable window. Probably not a great day to initiate something today, but in general, option income strategies have been given the all clear sign to be able to initiate. Covered calls, still that equal distribution between in the money and out of the money. Put selling, slightly bullish, so absolutely has been acceptable for selling puts, especially when you get a dip, to be able to set up your trade entry against a core portfolio basket of stocks that you are willing to own. And in terms of our sector analysis, sector market posture, quite a bit more green than red. Still not uniform. This has definitely been a kind of stock pickers kind of market, a sector and industry specific kind of focus. Healthcare generally continuing to be good. Retail continuing to be good. Other sectors much more distressed. Certainly energy and utilities have most consistently been under stress of late. And you see in the percent change yesterday, slightly down across most sectors. Only information technology, basically we'll call it a scratch. Industry groups, we've seen some movement in this group lately. Retail at the top, railroads, biotech now third, internet, healthcare, and transportation making out our top 6 industry specific groups. So if you get an all clear bullish signal coming out of FOMC, those would be the sectors to focus on in terms of new positions with the most wind at your back. As always, greatly appreciate you liking us on YouTube or wherever you find us on your social media favorite platforms. That does make a difference, and we greatly appreciate you liking us on the various platforms. If you have some comments you'd like to send in, please do. It's support@falconglobaltraders.com. More information about what we do in modeling our trades in the 3 live trade rooms, or of course our daily price guide product for day traders. Very, very comprehensive tool to help day traders trade better and in a more aware fashion each and every day. Disclaimers as always, hit the pause button if you need more time to read this. And then as always, we greatly appreciate you each and every day in the Falcon Global trading community. Good trading. We'll see you back here, same place tomorrow.